Hello there, Mavericks. It is the weekend. This is Rob Reinhold, and this is the Trading Room. Let's jump into the markets. In this session, we're going to talk about what happened this last week. We're going to take a look at the week ahead, score everything from +3 to -3, and that's going to tell us which sectors are moving.
All trades and analysis in this video are for professional traders only. This video has been released to the public after a delay required by our compliance department. Maverick traders receive this market recap immediately, along with real-time trading support and resources. Maverick Trading is a proprietary trading firm that backs professional stock and options traders with firm capital. Our traders keep 70 to 80% of the profits they generate. If you're ready to become a professional trader, click the apply link in the video description below. Let's break down what happened in the markets today.
Before we jump into the markets, I am very happy to announce that we are going to be doing live classes again. For years, we started doing live sessions in 2007. And for years and years, we always had live sessions where we had 90% of the people attend the live session and 10% of the people watch the video. In 2018 or 19, we found out those numbers had switched, where 10% of the people were coming to the live session and 90% were coming to the video. So we asked our traders, do you want more videos or live classes? And they overwhelmingly told us, we want videos. So we switched to all videos, which was great. But after all the years we've been talking, and we just, especially after our summit, we just realized we've lost some community at Maverick. So we are going to be bringing that back. So from here on out, every Wednesday is going to be a live midweek update, kind of like we used to do. And Joe's going to be running most of those sessions. So if you are available at noon Eastern time, that is going to be the time it starts. Let me show you how to go in and register for that. If you come to the website, come to the homepage, go to the calendar, click on the Wednesday, and it's going to open up a little menu down below, Midweek with Joe Live. Click on that link, and that's going to take you to the registration link. We're going to be doing these all through Google Meet. So if you come down here, this is the link to join. But if you want to put it on your calendar, if you want to, quote, register for it, go ahead and just add it to your calendar here. And it will go in and just hit save, hit this button save, and it's going to be there. And the link is going to be included in there. We're really excited to bring back these live sessions. And in these live sessions, this is where you can ask questions. The chat will be open. You can talk and meet with other traders and get some feedback on some of the trade ideas that you have. One of the other things we are going to be announcing on Monday is we are going to be adding an official Maverick Trading Discord server. We had an unofficial one for about a year, and it's time for us to make it absolutely official. We'll be sending out information on Monday saying, hey, why don't you join the Discord server? That's where you can go in, have discussions with other Maverick traders, and it's just a really great way to bring community. After our summit, we all talked and said we've got to do more things to get our traders involved with each other. This is a real focal point of our efforts lately. Last week was a very eventful week, so let's get into some of the drama here. The markets bounced off of a bull pullback, and then they failed to make new highs, which means we're not going any higher most likely. So we're in a high base pattern. We're going to take a look at these charts. But I want everyone to understand where we are seasonality-wise. The first 2 weeks of June have always been a little bit boring, a little bit slow. And we also see that in August. Now, I jumped into ChatGPT and I actually asked it, hey, what are the actual numbers here on the first 2 weeks of June? So I asked it, hey, tell me on any average 2-week period, how does the first 2 weeks of June match up? And you can see the average return is less, the win rate is less, the volatility is less, and the true range is less. Exactly what I thought is that we're going to likely have less movement, less volatility, just less of everything. This is a seasonality pattern, so any given year, it means it could be wildly different. But if you made the same bet every single year, you would be right. There's one thing that can shatter this all, and that's the tariff drama that's going on. But we're seeing a lot less movement when we have this drama. So let's talk about what happened this week. President Trump came out and claimed China violated their trade agreements to delay the tariffs. Remember, we're on a delay while they negotiate. And President Trump said, hey, they violated the agreements. That means that maybe that delay is going to be yanked away. We're going to go back to 165% tariffs or some crazy number. That's a fear of the market. We also got a ruling out of a trade court that said that the president cannot use the Emergency Powers Act, enact tariffs. Only Congress can do that. So all of a sudden, now all the tariffs are gone. Literally all the tariffs, even the 10% tariffs blanket, it's all gone. And then the very next day, a higher court said, hey, we're going to put a stay on that order until we can talk it out. So tariffs might be gone altogether, or we might ratchet back up to where we were in April, where they were 165% tariffs on China. It's drama, but the market is really shrugging it off. They're really getting to the point where it's like they're believing that tariffs aren't really going to happen. And every single threat that the president makes is taken less and less serious by the market. And we saw that with bond yields. They fell back right down into the 4.4 area. That's really been right in the middle of the range. And the market's very happy with the 10-year bond at 4.4%. Let's take a look at some of the economic news last week. We got durable goods orders. We're better than expected. Better than expected. Still pretty terrible, but better than expected. The core number was good. We got consumer confidence. It roared back. This is what I'm talking about. This is why the market has bounced back. We priced in a recession in April, and the numbers did not come out as recession. None of these numbers are recession except for this one. We got revised GDP. The first quarter was negative 0.3. Well, they said it's only negative 0.2. Who cares about the first quarter of this year? Take a look at some of these other numbers here. The core PCE price index, inflation, is down to 0.1%. Again, the economy is holding in surprisingly well, and that's why the market has come back, because the economy did not fall off a cliff like we were all worried it was going to do. So this week, we had another up week. Not as strong as the last couple of weeks, but you can see Dow up 1.5, S&P up close to 2, Qs up close to 2. We did see big pullbacks in gold and Bitcoin this week. We take a look at the S&P chart. We ran up to this high. We came off of it, had a nice bull pullback. And then we had a really nice candle on Monday. This is a gap higher, and then they bought all day long. But you can see over the next couple of days, the buyers just weren't there. There wasn't any heavy selling, but it just wasn't enough to push it over that line. So at this point, we can't say that this is a bull pullback pattern. It failed miserably this week. So we have to shift to this is a high base pattern. And the high base pattern is going to go sideways until it breaks to the upside, which is the most likely thing to happen on a high base. Of course, it can always break down. News can come out. But at this point, you have to switch from the market was bullish to the market is in consolidation at the moment. You just have to make that switch. The NASDAQ looks a little bit better, but still pretty much the same. We got 3 candles here that just said we're not ready yet. We're not ready to break to new all-time highs. We're just not ready yet. There's too much uncertainty out there. So it is a base, is the outlook for the next week or two. We take a look at the heat map. You can see we just had green across the board. Where there was a little bit of weakness was a little bit in the software area. And healthcare that had been weak actually roared back nicely. We'll take a look at that sector as well. So the word is range bound. We're likely to stay in this high base range on the SPX, 5760 to 5970. Right around in that range. That's like a 1.6% range. That's not a very big range. And if you take a look across all the markets, everything is range bound. Bonds have been range bound for a while. Forex isn't really going anywhere. Commodities are not really going anywhere. Gold, oil, they're all just sitting there. It's happening across the board. At some point, that will change. Yes, I know that. But right here, right now, we have to trade the market in front of us, and it's telling us the market's just not going anywhere. And now we're going into the first 2 weeks of June to where there's even less movement and less volatility. I really think we're just going to just hang out, and it's going to be a pretty boring market here for the next 2 weeks. Now, that being said, we're also in this weird little moment where the tariff news can throw a wrench into everything. So unless something really crazy happens, I think this market is really just range bound in the foreseeable future. This week, we do have some big economic news. We've got ISM on Monday. We've got ISM services on Wednesday. And then we have the non-farm payrolls report on Friday. But take a look at these numbers. These numbers are all okay. Take a look at ISM. It's supposed to get a little bit better. Take a look at ISM services. It's supposed to get a little bit better. Take a look at employment. Employment up 130,000. That's still okay. We have to do 100,000 to keep up with population growth. So it's still okay. Everything looks okay, which tells me we just got to stick with where the market is. The market's at a +2. It's just where it is. I think this week is likely to be a 0 on the week. I think we might trade up a little bit. There's definitely more of a bullish bias than a bearish bias to this market. But I think this is just where we are. We have to expect that the next 2 weeks or 3 weeks or all of June are going to be really boring and really sideways. We just have to accept that. Let's go in and take a look at the sectors and see if there's been any changes at all. This week, the only standout that we really saw was real estate. Real estate had a nice bounce back. But you can see everything else pretty much was a market return, pretty much was right around what the market did, except for materials and energy. Energy actually had a down week. So we'll take a look at all these charts. Let's go through these fairly quickly because you're going to see not a lot changed. Last week, utilities was at a +2. It's basing. No surprise, the market's basing. This is basing. You're going to see that pretty much everything is basing. We got a little pullback here on comm services, but it's still a +2. It's still telling you be net long this thing. Moving on to real estate. Real estate was a 0 last week. We're going to put it at 0. It had a decent week, but you can see it didn't break it out of anything. It's just going nowhere. Moving averages are going sideways. So we're just going to leave that at a 0. Healthcare was a -3. It's now back to the 20-day moving average, so it is going to be a -2, but it's still a bearish sector for sure. Going to industrials was a +3. It's going to stay a +3. Now look, if you said, hey, I want to downgrade this to a +2 because it didn't make a new swing high, okay, +2, +3, it doesn't really matter. This is one of the stronger sectors out there. Here is financials. It's going to be a +2. Last week, we downgraded it to a +1 as it broke below this 20-day moving average. It recovered and held in pretty well, so we'll go to a +2 on this. Consumer was a +2 last week, is a +2 this week. Again, consolidation. That is the name of the game. We're consolidating. Here is consumer staples. Consolidation as well, but you can see we're starting to poke against the top end of that range. It was a 0 for a long time, going to a +1 on this one as it's showing a little bit of strength. Technology was a +2. It's going to stay at a +2. It is just consolidating. As you can see here, everything is consolidating. Everything is just moving sideways. And in energy, was a -1 last week. It's a -1, but ultimately just consolidating. That is the name of the market right now. It's not the market I'd like. It's not the market I want, but it's the market that is. And you know our saying at Maverick, trade the market in front of you. Just accept it. What that means is that anyone looking for real strong trending moves, you're very frustrated. If that's what you're looking for, if you're looking to buy long calls and long puts, you're very frustrated. If you're looking to do really wide spreads, you're frustrated. It's not the market we're in. You have to adapt and change your trading to fit the market you are currently in. If you keep trying to trade the same exact way in every single market, you're going to find that some market situations you don't do well. And it's not because of your strategy. It's not because you're not smart. It's just because you're not matching up with the market in front of you. Let's take a look at the few moves that happened here. Financials, we're bumping it up to a +2. Staples moved up. Healthcare moved from -3 to -2. But you can see it's pretty clear what is still strong. It's the same stuff. Utilities, financials, tech, comm services, consumer and industrial, all the cyclical stuff. And what is not doing well is some of the stuff that's non-cyclical. It's not doing terrible, but it's just hanging out there. So let's go ahead and look for some potential trades in some sectors. I've been talking for the last week or two, and this has been different. Remember, about 6 or 7 weeks ago, I said, hey, it's time to start putting capital in play. It's time to start being aggressive because the market was really charging and really trending. And last week I said, okay, there's less reason to be aggressive. Let's pull it back. Let's get less bullish and let's put less money on the table. And we only had 6 trades on last week. 3 of these rolled off. We had trades that rolled off in the healthcare sector. We had a Bristol Myers trade that ended up being a max loss. We had an AIG trade that ended up being a break even. And we had a Suncor Energy trade that ended up being a nice win on a butterfly. Pretty much close right around our butterfly point. So that leaves us just with 3 trades. Remember, you get to allocate capital as a trader. You get to decide how much capital is out there and where it is. That's the only thing we have a control over. We don't have control over what the market does. It's going to do what it does. We have control of where we put our capital. Yes, we could put a lot of capital to work because we don't have a lot on the line right now. But guess what? It's not the market for that. Yes, it's a +2, but we're in consolidation. We're in sideways. Once we break out, then we can go ahead and get a little bit more aggressive. But until then, I'm in no hurry to put a lot of capital out there. Remember, it's waves, it's ebbs and flows in the market. Trends, consolidation, trends, consolidation. If you're a trend trader and you put a lot of capital out when the market's trending, and then you pull that capital out when it's consolidating, that's a win right there. You're going to really be able to gain an edge in your trading just by doing that. I'm only looking to put on 4 more trades, going up to 7 trades, not a lot of capital out there. Utilities, I'm going to be slightly bullish. Real estate, I'm going to be a 0. And healthcare, I don't have any bears, so I'm going to throw on a healthcare bear and an energy bear. Those are the 2 weakest sectors. So let's go take a look at some of those possible trades in those sectors. In the utility sector, looking at NRG Energy. There were a few that I liked more, but I just couldn't get any of the options numbers to work. So I ended up having to go with this. And it's just a beautiful chart. It's just a high base. Remember, we're looking for a +1 trade. A +1 trade is not super directional. It's more sideways to slightly up. And this chart looks like it's going to hold up in this 155 area until it high bases and breaks out. So I'm looking at this June 13th, 152.50 to 175.50. I just need it to go above the top of this little window. That's where it needs to be in 2 weeks. And if that happens, I'm at a max gain. If not, then I've got my controlled loss. If you want to be a little bit more aggressive and go with a +2 trade, then it's going to be the 155, 160. As you can see, still not very aggressive whatsoever. Maybe this thing goes to 170 once it breaks out. But for me, I'm just looking for this as a stock that's going to hold its gains and claw its way a little bit higher. That's all I'm asking it to do with my +1 trade. In real estate, we're looking to put on a 0 trade. So I'm looking for something that's not going to go anywhere. And there we have American Tower. You can see that the range for this is basically 202 all the way up to like 227. Now that's where it is. This stock only has $10 strikes. And I was really hoping it had a 215 strike. It does not have a 215 strike, which means I either need to choose the 210 as my middle of my butterfly or the 220 as the middle of my butterfly. So I actually have to choose, do I want to be more bullish or bearish? It's right in the middle, and I'm going to go with more bullish. The market is tilted bullish, so I'm going to tilt a little bit bullish. So I'm looking to do the 210, 220, 230 butterfly. And I want it to float up into this area. That would be just a beautiful area for that to float into. That's going to be a nice gain. I gave it not a 0 on a butterfly. It's a targeted butterfly, a little bullish. So we'll give it a plus 0.5 on that one. Moving into the next one, we've got 2 shorts coming up, healthcare. And look, I'm not saying I want to be short this market, but all my shorts are gone. I don't have any shorts at all left, any bearish trades. So I do need to add some on based on my strategy and how I trade. I wanted to find the worst. When you're looking to find some bearish ones, even in like a bull market, you want to still find the worst. And this one looks atrocious. This is Apellis Pharmaceuticals. I've never traded this one before, but you can see here, it just looks like a low base. I don't want to trade this super aggressively. This thing probably breaks significantly lower, especially if we have some selling in the sector and in the market. But I still don't want to get too aggressive here. I'm looking to be a -1. I'd already determined I'm going to be a -1. So that means I'm going to do an 18-16. The stock is virtually right in the center of that. So this is going to be a 50-50, 1-to-1 risk reward. Basically, if it's above 18, I lose. If it's below 16, I win. And anything in between is going to be small win or small loss. And then lastly, energy. I want to do a short or a bearish trade in energy. Same thing. I'm looking for the worst. I want to find stuff that's really done terrible. And I came across Halliburton. Halliburton, this looks really terrible here. We got a descending triangle again forming. I don't think this is going to break all the way down to like 17. It's just not the market for that. I think it's going to be sideways to down here because of the weakness of the stock. I already determined I'm doing a -1, so I want to do a trade that isn't all that bearish. So a 2019. Looking to do a 2019 bear put spread. Again, this is going to be very close to, I'm probably going to pay 45 cents and I'll have a 55-cent upside potential on it. Not a very aggressive trade, but that's the design. I only want it to be -1 in this sector, so that's what I'm going to be. Remember, you have control of your capital, how much capital you put out there. I don't love the market here, especially for trending things. If you are a vertical spread person, that's your style, and you like to do a 1-to-2 or a 2-to-1 risk reward ratio, this is the wrong market for that. You're going to struggle. You're going to have a hard time finding things, and you really got to search for things that are moving and have volatility. Other than that, there's really no reason to get aggressive on anything here. So I'm going to repeat again for the second week. I said this last week. There's less reason to be bullish. And I'm going to say it again. There's just less reason to be bullish. It doesn't mean I'm bearish. I'm not bearish at all. The trend is still higher. But we're moving into a period that seasonality is usually lower. Everything is stacking up against movement. Everything is going sideways. It's all stagnant. Don't fight the market. Don't fight what the market's doing. Try to match what you're doing as closely as you can to the market. It's going to make your job and your life a lot easier as a trader. Thank you so much for joining me. Everyone have a great first week of your summer. Goodbye, everyone.